What if you could buy a dollar bill for 80 cents?
I mean, you'd immediately think it was a scam, right?
Exactly. Seriously.
Yeah.
Imagine someone just like holding out a crisp $1 bill and they're practically begging you to take it off their hands for 80 cents. You'd assume there's some massive hidden catch that you just aren't seeing.
Oh, absolutely. Or that the bill is counterfeit.
Right. But as we look through your sources for today's deep dive, that exact mathematical anomaly is actually playing out on Wall Street right now, like on a multi-billion-dollar scale.
Yeah, we're looking at a situation where extreme market psychology has just completely detached a company's stock price from the actual mathematical reality of the assets sitting in its vault.
It's crazy.
It really is. It's arguably one of the most severe financial disconnects in modern market history.
Okay, let's unpack this because that is exactly why we are diving into the current incredibly high-stakes financial stress test of MicroStrategy today.
Yeah, often referred to in the source materials simply as strategy or by its ticker, MSTR.
Right, MSTR. And our mission today for you listening is to really look under the hood of this operation to figure out a central question, which is this company on the brink of total disaster? Or are we looking at, like, the ultimate contrarian value play of the decade?
And to answer that, we have to recognize that strategy just isn't operating like a traditional corporation anymore.
No, not at all.
Right. Over the last few years, it's basically mutated into the market's primary proxy for Bitcoin exposure. And that has completely overshadowed its actual, day-to-day operations.
Yeah, they hold roughly 4% of the entire world's Bitcoin supply, which is just a staggering amount. But before we get pulled into the gravity of that massive crypto treasury, we really need to understand the engine that actually keeps the lights on.
Because there is a foundational revenue-generating business here.
Exactly.
Yeah.
They aren't just some shell company holding digital coins.
Far from it, actually. The market is pricing the company as if it's purely a crypto vehicle. But strategy has like a 35-year legacy in an enterprise software.
35 years.
Yeah, they're a foundational player in data analytics. And right now, they're pivoting heavily into artificial intelligence with a platform called Mosaic.
Right, Mosaic.
Yeah.
And the sources describe Mosaic as a standalone semantic layer, which, I mean, sounds incredibly futuristic.
It does sound like sci-fi.
It really does. But when I dug into the mechanics of what a semantic layer actually does, it's much more foundational. It's essentially a universal translator for a corporation's business logic.
That's a great way to put it. Let's break down how that actually functions in the real world.
Yeah.
So imagine a massive global corporation, right?
Right.
They might use, say, Oracle for their accounting, Salesforce for their customer relations, and maybe a dozen other platforms across all their different departments.
Right. Totally fragmented.
Exactly. So the problem becomes, how do you define a simple term like revenue? Does it include pending sales? Does it account for different fiscal calendars across, 20 different countries?
Oh, man. I can see how that gets messy fast.
Right. If those systems don't agree on the fundamental definition of revenue, chaos ensues.
So Mosaic basically sits in the middle and enforces the rules.
Precisely. It makes sure that no matter what software department A or department B is using, the underlying definition of the data remains completely intact. It's totally standardized.
So why is that such a defensive and valuable position right now?
Well, it ties directly into the whole AI boom. The broader tech market right now is absolutely obsessed with infrastructure costs. I mean, everyone is panicking over how much companies are spending on servers, processing power, specific AI models.
The hardware and the compute, basically.
Yeah, all of that. But Strategy's Mosaic platform is platform agnostic. It sits completely above the infrastructure.
Meaning, if a company decides to, I don't know, fire OpenAI and hire Anthropic tomorrow, or if they switch their entire database provider?
It doesn't matter to Strategy at all. The underlying business logic still has to be governed, regardless of the AI model. When an AI agent queries a company's database, that semantic layer is what prevents the AI from hallucinating incorrect financial data.
So because Strategy provides that agnostic layer, their legacy market share is just deeply entrenched.
Highly entrenched. It creates this very solid, highly reliable, recurring revenue base that operates, completely independently of the wild volatility we see in the crypto markets.
So to put it in perspective for you listening, is like this company has a highly stable, incredibly boring day job as a corporate accountant, but like they are moonlighting as a high-stakes, billion crypto day trader.
That's the perfect analogy. And honestly, the boring day job is the only reason the moonlighting hasn't destroyed them yet.
Right.
Because that crypto side of the business is facing an existential stress test right now.
Let's look at the sheer scale of this crypto treasury, because it's massive. Strategy holds 847,363 Bitcoin.
That's a lot of Bitcoin.
It is. But the critical number here is their average acquisition price, which sits around $75,651 per coin.
And with Bitcoin prices falling significantly below that cost basis recently, the unrealized losses are they're staggering.
Yeah, looking at the documents, we are talking about aggregate paper losses somewhere between $10.6 billion and $12.38 billion.
A $12 billion paper loss.
It's hard to even wrap your head around that number. You can definitely see why Wall Street is stepping back. The stock itself has faced absolute capitulation.
Oh, a total bloodbath.
It plummeted over 80% from its cycle high, hitting a 2-year low in the $86 to $94 range. It even broke down below the $100 psychological support level.
Which is a big deal. The sources note that losing that $100 level is usually like a line in the sand.
Right.
It's where institutional investors are essentially forced by their own internal risk models to completely reassess or just dump their positions.
So maximum pessimism is fully set in.
Completely. But that resulting price action is actually what created that 80-cent dollar anomaly we talked about at the start.
Right, the discount.
Yeah, right now, the stock is trading at an approximate 0.8x discount to its Bitcoin net asset value, or NAV.
Let's translate that NAV discount into practical terms for the listener. If you add up the current market value of all the Bitcoin they hold in their treasury,
Yep.
and you divide it by the number of shares they have outstanding, the stock is trading for 20% less than the raw value of the Bitcoin it represents.
Which historically is a massive anomaly. For years, Strategy actually traded at a huge premium to its NAV.
Why a premium?
Well, institutional investors, like massive pension funds or endowments, they were legally or structurally restricted from buying spot Bitcoin directly.
Oh, right. They couldn't just open a Coinbase account.
Exactly. So they bought Strategy stock as a proxy, and they were more than willing to pay a premium just for that access.
But now that spot Bitcoin ETFs exist, that scarcity premium is totally gone.
Poof, gone. And the fear has driven it the other way into a steep discount.
Okay, so if I'm an investor looking at this, I'm thinking, wait, so if I buy the stock, I'm essentially buying their underlying Bitcoin holdings for 80 cents on the dollar.
That's the math.
But there has to be a catch. What's the catch? Why isn't everyone on Wall Street backing up the truck to buy this stock? If it's on sale, why the panic?
Because holding a multi-billion-dollar crypto treasury isn't free.
Right.
The company took on massive leverage. I mean, they borrowed billions of dollars to buy all that Bitcoin. And those loans come with massive annualized dividend obligations.
How massive are we talking?
We are talking about $1.2 billion in annual dividend commitments just to service the yield.
Wait, if they owe $1.2 billion a year just to keep the lights on for their debt, why wouldn't they just, issue new stock or bonds to raise the cash? I mean, that's what normal companies do when they need liquidity.
And that brings us to a major structural breakdown in their capital stack. The sources highlight that their preferred stock, the STRC shares, has collapsed.
STR.
Yeah. It's currently trading at a 16 to 25% discount to its $100 par value.
Let's explain why that matters. Preferred stock is essentially a hybrid between a stock and a bond.
Right. Pretty much, yeah.
And it's usually held by VIP institutional investors who just want a steady, reliable payout. So if those VIP shares are trading at a 25% discount, it means the big players are actively dumping them.
Exactly. And when your existing preferred shares are heavily discounted like that, you are effectively frozen out of the capital markets.
Wow.
Think about the mechanics of it. If they try to issue new shares to raise that $1.2 billion, they'd have to price those new shares at that same deep discount.
Which would severely dilute the value of all the existing shares.
Right. It would just destroy value for current shareholders.
Yeah.
So they've lost the ability to raise what we call accretive capital, which is money that actually adds value to the company rather than diluting it.
Which sets up this absolute nightmare scenario. The core risk here is what they're calling the doom loop.
The dreaded doom loop.
Yeah. Because if we enter a prolonged crypto winter and Bitcoin stays depressed below their 75K cost basis, they can't raise accretive capital. But that $1.2 billion bill they still do.
And if they don't have the cash,
They are forced to sell their Bitcoin.
exactly. Selling their Bitcoin into a weak market just to cover dividend payments permanently locks in those billion-dollar unrealized losses.
It's a totally vicious cycle.
It really is. They sell Bitcoin, the value of their treasury drops, the stock price drops even further, making it even harder to raise cash, which then forces them to sell more Bitcoin. The whole underlying thesis of the company as this relentless Bitcoin accumulator gets completely destroyed.
And the macro environment right now is basically throwing gasoline on this fire.
Oh, absolutely.
The sources mention that the Federal Reserve's favorite inflation barometer just hit a 3-year high. And that data alone sparked a massive, broad tech sell-off.
Right. Strategy didn't just fall in a vacuum.
No. Giants like Microsoft and Palantir plunged to 52-week lows right alongside them.
When you have macro inflation fears combining with a structural breakdown in a specific company's balance sheet, you get forced deleveraging.
Everyone just runs for the exits.
Yeah, the market starts pricing in the absolute worst-case scenario. Investors are demanding that 20% discount on the stock because they require a massive margin of safety.
They're legitimately terrified the company's going to run out of cash and be forced into that doom loop before Bitcoin even has a chance to recover.
Yeah.
So the trap is set. They owe $1 billion, they can't borrow more, and the market assumes they're going to have to start liquidating their crypto vault. But management just made a defensive pivot that throws a massive wrench into that bear thesis.
They did. They executed a very specific liquidity maneuver. Recent disclosures show that management actually generated $335.5 million by selling 2.71 million shares into the market.
Now, historically, their playbook has been completely predictable. They raise cash, and they immediately dump every single cent of it into buying more Bitcoin, regardless of the price.
Right, always buying.
But this time, they only bought $35 million worth.
Which is a tiny fraction of their usual purchasing volume.
Yeah, it's nothing for them. The remaining $300 million was used to rebuild their U.S. dollar reserves. That brings their total cash cushion up to $1.4 billion.
And if we look at the mechanics of that cash pile, it changes their entire survival timeline.
How so?
Well, remember, they owe $1.2 billion in annualized dividends. But with $1.4 billion sitting in the bank in pure cash, they have mathematically eliminated the immediate risk of forced liquidation.
I see.
Yeah, they have a solid 10-month runway to fund their dividends entirely in cash.
So they essentially bought themselves a 10-month umbrella. They can just stand there, watch the crypto winter rage all around them, and not sell a single digital coin if they don't want to.
Exactly. And from a quantitative sentiment perspective, this is the exact signal institutional holders needed to see.
Because retail investors are probably panicking.
Totally. The retail headlines are hyper-focused on the 80% stock drop and the billions in paper losses. But institutional money, they look at the balance sheet.
Right.
By building that cash reserve, management proved they're actively de-risking. The doom loop requires forced selling. But by securing a 10-month runway, selling becomes totally optional. The worst-case bankruptcy scenario is heavily priced in, sure, but the immediate solvency risk has been removed.
Okay, so surviving the storm is a great first step. But just treading water for 10 months isn't going to magically fix an 80% stock crash.
No, it won't.
Right, so how do they actually force Wall Street to close that valuation gap? Like, how does the stock actually recover?
Well, here's where it gets really interesting. The potential catalysts for reversal are fascinating, mostly because of where the advice is actually coming from.
Right.
Peter Schiff, who is notoriously one of the most prominent Bitcoin skeptics on the planet, publicly suggested that Strategy should completely pause its Bitcoin purchases.
Which is pretty rich coming from him.
Yeah, but he argued they should use their cash to repurchase their own shares instead.
Taking strategic advice from your biggest critic is definitely a plot twist.
It really is.
But it wasn't just Schiff, right? CryptoQuant, which is a major crypto analytics firm, echoed the exact same sentiment. Pause the buying, rebuild the cash, and look at the equity. And rumors are actively swirling that management might do exactly this.
Let's map out the mechanics of a stock buyback in this specific environment because it's really crucial to understand why it's so potentially explosive.
Let's do it.
So the stock is trading at a 0.8x discount to its net asset value. If management uses their cash reserves to buy their own stock at that 20% discount, they instantly accrete value to the remaining shareholders.
Let me see if I have this right. Think of it like a shrinking pie crust, where the filling stays the exact same size.
I like that.
If they buy back and retire those cheap shares, the total number of shares goes down. But the Bitcoin treasury, the filling hasn't changed at all. So every remaining share suddenly represents a much larger, denser slice of that Bitcoin treasury.
That's spot on. And that mathematical reality forces the valuation gap to narrow. The 80-cent dollar gets naturally pushed back toward a full dollar.
Right, the math corrects itself.
Exactly. But there is a secondary mechanism here that is even more volatile.
Oh, the short sellers.
Yep. Because of all the fear surrounding the dividend doom loop, the stock has been heavily shorted.
So investors have borrowed shares and sold them, basically betting the price will keep falling when the company is inevitably forced to liquidate its Bitcoin.
That was the bet. But we just established that the cash reserve removed the doom loop from the equation entirely.
The fundamental thesis of their short bet has been neutralized.
Totally. So if management steps in and starts buying back shares, reducing the float and driving the price up, those short sellers are suddenly trapped in a burning room.
Ouch.
As the price rises, their losses compound. And to stop the bleeding, they have to buy the stock back to cover their short positions.
Which creates a massive feedback loop. Management buys, the price goes up. The shorts panic, they start buying to cover, which drives the price up even faster.
Yep, other shorts get margin called and are forced to buy.
It just triggers a violent vertical short squeeze.
Exactly. And the crazy thing is, that match doesn't even have to be lit by management. We have to factor in the macro environment, too.
How so?
Well, the whole reason this capitulation started was inflation fears driving tech stocks down and dragging Bitcoin down with them. The market is heavily pricing in a hot inflation environment right now.
Right, so if the Federal Reserve issues like a dovish surprise, or if the next inflation report shows significant cooling, you get a massive relief rally across risk assets.
Exactly. And if a macro pivot pushes Bitcoin back above their $75,651 cost basis, those unrealized losses just vanish.
Go on.
The psychological pressure lifts, the NAV discount likely reverts back to a premium, and the entire bearish thesis evaporates overnight. The shorts would be forced to cover just as violently in that scenario.
Wow. So looking at all these intersecting forces, you've got the deep NAV discount, the trapped short sellers, the 10-month cash runway, and the macro headwinds. What is the final takeaway from our sources?
Synthesizing the research, the situation yields a bullish score of 6 out of 10.
6 out of 10.
Yeah, it is definitively categorized as a high-risk, contrarian turnaround play. You are essentially making a 3 to 6 month tactical bet on two things happening: inflation cooling down and Bitcoin mean reverting back above their historical cost basis.
A 6 out of 10 means this is, far from a sure thing. The risks are incredibly real.
Absolutely.
But it is a masterclass in how extreme market pessimism can create these wild mathematical disconnects. I mean, when fear takes over, you get situations where a company's stock trades for 20% less than the cash equivalent assets sitting right there in the vault.
But finding that discount is only half the battle. The real trick in value investing is determining if the company has the balance sheet endurance to survive long enough for the market to realize its mistake. And that $1.4 billion in cash ensures strategy gets to stay in the game.
It brings us right back to that dollar bill being sold for 80 cents. It looks like a scam until you realize the person selling it is just desperate for immediate liquidity. If you have the endurance to hold on to it, the math eventually wins out. It's still worth $1.
Time horizons and liquidity management. That's what dictates survival on Wall Street.
Absolutely. So as we wrap up today's deep dive into the mechanics of this stress test, I want to leave you with a thought to mull over. If MicroStrategy successfully navigates this 10-month runway, and they actually weaponize their own discounted stock to trigger a massive short squeeze against their doubters, will other legacy companies start looking at extreme balance sheet volatility not as a fatal risk, but as a brilliant strategic playbook? Until next time, keep questioning the consensus.